Hey guys, it's May from Markets with May, and in this episode we're going to explore the question of whether the SEC is failing to protect investors from naked short selling. So this video is a thank you to all of the support that I got on my last two videos describing the press release that came out on AMC. Now, while this video is going to be relevant for anyone that is interested in learning more about what's going on in naked short selling, Reg SHO, the borrow rates, and what synthetics has to do with all of it, I'm really going to use AMC as a case study, first of all, because it's an amazing case study. And also, my AMC apes were amazing and supportive, and some of you just requested I do a video that broke down in simple terms what's going on in naked short selling. Now, I'm going to cut to the chase here. Do I side with the SEC or do I side with the investors that feel unprotected from naked short seller? I do actually side with the investors that feel unprotected from the naked short sellers, and that's despite the fact that it may be the case that because of the way the regulation is written, that there's violations to the spirit of Reg SHO versus what's actually being posted. But I am going to go through all the components of this so you can make this decision for yourself. Now I'm going to do the disclosures, not because I'm trying to trick you, as some people put in my last comments, but because the SEC's already come down on more than one social media person for failing to do the disclosures. So past performance is not indicative of future returns. This is not investment advice. This is for educational purposes. You have to make your own investment decision. Now I always give a shout out to Gorilla. Money goes where it's treated best, and there's a link in my show notes if you want to check them out. Additionally, because I'm using AMC as the example in this video, I am a shareholder of Ape shares. I do not own AMC. And now let's get into, is the shareholder being protected from naked shorts by the SEC? Now this matters a lot to AMC shareholders and has for some time. The short interest in AMC is very high. Currently, the NYSE is showing it around 20% as I look this evening, but at different times it's been higher than that. Now, one of the reasons why I think this is really hard to figure out the answer to the question as well as get good information on is because it does actually require that you fully understand Reg SHO, which is a legal document. You understand the case law precedents associated with Reg SHO, and you also understand market mechanics extremely well. And that's a lot. Now there's a lot of really great videos on Reg SHO and then on AMC specifically Reg SHO. And I want to give a shout out to those people. Where Are the Shares does an amazing job. Andrew Moe, I think you did a great job when you did your video last year. And Major Tom Official, also a little bit intense, but the guy really does know what he's talking about. I'm hoping that the way that I lay it out makes it easier for you to understand some of those other channels that are far more dedicated to keeping up with this on the day-to-day. And I mention that because Markets with May isn't an AMC only channel, and some of those guys are just doing amazing work to keep investors up to date. So shout out to all of those guys. Now, the SEC enacted Reg SHO in 2005 to govern short selling. Now let me try to break this down a little bit. Short selling is when you sell a stock first and then you buy it back later. Now you always want to sell high and buy low, sell high. In this case, you're thinking that the price is too high, so you're going to sell it first, and then hopefully you're not wrong and you get to buy it back at a lower price. If you're wrong and the stock shoots up, then you are absolutely going to take it on the chin, and you can take it on the chin to greater than 100%. Now hold that in your head for now, because the fact that you can lose greater than 100% is really important later when we talk about the borrow cost. Now Reg SHO was really enacted because there was a concern that you could, given the market structure previous to that time, short more shares than actually existed. In other words, let's just say you and your buddies decided to gang up on a stock and literally keep entering orders and selling orders beyond the number of shares outstanding. Before Reg SHO, broker-dealers just kind of had to figure that out. There wasn't a standardized process. I mean, there were some common things that people did, but there wasn't a standardized process on how you would clear all those trades. Now, there may be other case law. I'm not a lawyer, so I don't know this cold, but essentially, Reg SHO is the regulation you look at to get the definition of what naked short selling is. And it defines it relative to this concept called, number one, getting the locate on shares, and number two, a concept of a borrow and a borrow rate. Here is the process that the locate is attempting to describe. Whenever you short a stock, you have the intention to buy it back at a later date. The SEC created the concept that the broker-dealer must already know which stock it is will correspond to covering the short sale so that you'll never end up with over 100%. And the reason they really wanted to do this was for the stability of the broker-dealers. Because quite frankly, if you were as a broker-dealer were allowing this to happen and the short doubles, triples, quadruples on you and there's no stock for you to buy, then you actually do, as the broker-dealer, also bear some of your client's risk. Now in other markets it's a little bit different, but you'll get a sense for it if you watch this movie, Trading Places. It's a movie with Eddie Murphy, and it's an awesome one to watch no matter what. Now I will tell you that before 2000, it was not as common to be able to locate stock easily because a lot of asset managers did not want their stock lent out. In fact, I know this kind of firsthand because one of my first jobs in the marketplace was to get the hypothecation agreement signed by asset managers that had large shares of specifically smaller cap companies. Now, what is the hypothecation agreement? This is a lending agreement between the person that owns custody of the shares and the broker-dealer. This allows the broker-dealer to lend out the shares. And even today, if all of the shareholders decided to disallow hypothecation of their shares, you would not be able to find a locate on any of those shares. Now in 2022, the hypothecation agreement is typically in that gigantic package of stuff that you either signed in paper or signed online. And most people are allowing their shares to be lent out. Now, if you don't want them lent out, there's a handful of things you can do. Some broker-dealers will allow you to specify that you don't want specific shares lent out. That's something you're just going to have to check with your broker-dealer. In other cases, you can directly register the shares. And this was something that was discussed on the AMC call last earnings season. One of the investors asked Mr. Aaron point blank, how's it going? Are people registering the shares with AMC directly? And he said, yeah, that's a possibility and we welcome that. At the same time, few shareholders have taken the time to do that. Now, can the shares be lent out in excess of 100%? Now, technically, you can have more shares short on a given day than the number of shares outstanding, the total number of shares that exist. There's a couple of nuances to it, and sometimes the broker-dealers will try to skirt the question, and you may see like half answers to this. But technically, as if all of those shares are collapsed downwards, you should still end up with the same number of shares short as the shares that are long. Now, I'm going to not talk about synthetics, but I know some of you are chomping at the bit for synthetics. We're just talking about shares at this point.
Now, if the number of shares short exceeds the number of shares available for borrow, then you have a fail to deliver on the settlement date, T+3, and you have naked shorting.
But there are some exemptions to the naked shorting rule, which we'll get into in a moment. The DTCC, which is responsible for clearing all shares that come through the system, is going to record that number. And typically, there are 3 days to settlement, so it takes 3 days of delay to know that there's an issue on clearing the shares. Now, let's say there's a bunch of shares that are short, there aren't enough shares to cover it, there's a 3-day settlement period, those shares have to be delivered, and if they're not, the DTCC will record that as failure to delivers, which is often abbreviated FTD. Now, a high failure to delivery doesn't necessarily mean that anything wrong was done. There is the ability of a market maker, broker-dealer to file an exemption to the failure to deliveries. And they would contend and they would file for that exemption because they would be saying that this is just a higher volume situation where you just needed a little bit of a remainder of shares to clear correctly. Maybe there was human error or some kind of computing error. And this is where it gets dicey. Now we're going to move into the exemptions and also some of the supporting evidence, and you're going to have to make a call for yourself. But I want you to keep in mind that the spirit of Regulation SHO is to protect investors against market manipulation coming from naked short selling. It is not a set of rules and procedures that if you follow them precisely, you're totally in the right. And the evidence associated with that is actually the 2013 case from Options Express. Now, even though Options Express was following Reg SHO to the letter, the activities they were engaging in were very much so market manipulation, and the SEC did fine against them. Unfortunately, the fines were really, really small. So what I'm saying is that it's not the point that you follow Reg SHO to the letter of the law, but you also comply with the spirit of the law. And there may be legal experts out there watching this that can clarify and say that that's not true, but that would be the case law that I would direct you towards is 2013 Option Express. Now let's talk about what happens when there is a failed to deliver situation that would absolutely be a big no-no. Now the key to this is this idea of threshold securities. Threshold securities are securities that have in aggregate failed to deliver in a particular way. And the rules of that are, number one, there have to be 5 consecutive settlement dates where you have an issue. And then the second one is it has to be at least 10,000 shares or more that are failing to deliver, and it has to be equal to at least 0.5% of the issuer's total shares outstanding. Now, because this is clearinghouse settlement, this should just refer to shares outstanding in a single CUSIP. So this should be 0.5% of the total shares of AMC, which is about 2.5 million shares. Now I want to put a pin in that because 2.5 million shares outstanding essentially is almost 10% of the daily average volume for something like AMC. Now, in 2005, a lot of these systems were still coming online, but in 2022, a number that equates to 10% of the average daily volume for a stock that is very heavily traded just seems really wide. On day one, short to your heart's content, and as long as by day 5 you bring it back to that 0.5% error rate, which they're calling it, then you're fine. So that's 0.5% of the shares outstanding. It's not 0.5% of the float, and it actually equates to about 10% of a given day's trading volume in the case of AMC. And again, this rule is supposed to be protecting the investor from market manipulation coming from naked short selling. And I mean, it just to me doesn't seem like it does that. Look, here's the thing. On small cap names, big investors absolutely do have enough ammunition to push the market. And you're giving a 10% window in a 5-day cure period with a 3-day trading settlement. You're giving a lot of wiggle room. And so I really would love for the SEC to just review this and whether or not it's actually protecting investors against naked short selling.
With this being the case, it seems that the only thing that could truly stop a malicious short seller from continuing to create fail to delivers and naked shorting is a margin call. The margin call would force a posting of capital or a covering of positions.
Now I want to talk about the 5-day cure period. A lot of folks posted that AMC was already a threshold security. And when I looked on the NYSE website, it is not. Now, I want you to understand that the DTCC publishes these numbers on a delayed basis to the public. So the numbers that we have are really from November the 30th, and you can see that it did in fact come very close to being a threshold stock, but it was not actually officially thresholded in that period. But like I said, the SEC should consider reviewing this because the number of shares shorted far exceeds the 0.5% threshold. And as long as it comes back down, regardless of the fact that it stays elevated just under the threshold number, it can be gamed all day long. Now, some of you have been following this for a long time, and you're quick to point out that the fines for violations of naked short selling are really, really small. Now, almost all the documents I read as relates to settlements for naked short selling related to the disgorgement of profits, but there is actually one other place where I would argue it's owed to the long-only investor, and that has to do with the borrow fee. Now, when you go to short a stock, you actually pay what's called a borrow fee. And the borrow fee is set by the broker-dealer and is supposed to compensate the hypothecator for lending their stock. In other words, you're supposed to be paid a borrow fee for allowing someone else to short your stock. And the borrow fees are supposed to get significantly higher as there's less stock on the locate. Now, the borrow rate is supposed to be a market mechanism that slows down the shorting of hard to borrow stocks. In other words, if it gets more expensive to short the stock, then some people will decide that there's not enough profit in it to continue to short it. Now, right now, there is an arbitrage trade going on between APE and AMC, where people are long the APE stock and short the AMC stock, believing that they can deliver the AMC stock via the reverse convergence of APE to AMC. Now, I want to show you what the borrow rate might look like for something like AMC. And as you can see, there's not a limit on what the broker-dealer can charge to stay within compliance of Reg SHO. Here you're seeing the borrow rate be over 100%, and you might think, hey, that means that they're charging 100% interest on borrowing my AMC stock, and that's a great price. But I'm going to tell you now, that's not true. This is an annualized number, and when you annualize it out, they're really charging about 2% a week for someone to then be allowed to short your stock in excess. And that would be fine if you had a lot of shares to lend out, but you only have 3,000 at the beginning of business day. You can't tell me that that 2% charge for the week is really enough to compensate the people that you're hypothecating and that you're actually trying to stay in compliance with Reg SHO. That's ridiculous. Now, this is where I just don't know, and if you're a lawyer watching, I would welcome you to comment below, but this almost seems like a consumer lending issue, not even an SEC issue. Now let's talk about exemptions under Reg SHO. One of the exemptions governs arbitrage trades, but this really is riskless arbitrage trades or arbitrage trades that are more direct. For example, if you have ordinary shares that are listed in Hong Kong and you have an ADR that's listed in the US, the daily differences that happen because two markets are closing at different times. And so that is absolutely viable for an exemption under Reg SHO. The exemption was not designed for merger arbitrage. In other words, you can't be long Xilinx, short AMD and file an exemption. You're just short AMD at that point. There's far too much risk and there's far too much potential that that transaction didn't go through. Maybe you could file for an exemption on the close of business. Now, if you were trying to file for an exemption between Berkshire A and Berkshire B, which is fully convertible, you probably could get away with filing for that exemption. Now, some might say, well, May, APE to AMC is convertible if the board approves and the shareholders vote yes. So shouldn't that be like Berkshire A to Berkshire B? And I would argue, no, it shouldn't be the case until the vote goes through, because Berkshire A to Berkshire B is fully convertible whenever you feel like it. APE to AMC is not. You still have two events that have to happen to allow that to occur. I would be interested if you work at a broker-dealer or if you work for the DTCC and that is actually an allowable exemption, please put it in the comments. Now, the last question that some of you guys had related to whether the synthetics market is incorporated in the naked shorting. And the answer to that is, from what I could see, no. Because if you think about it, an options contract isn't shorting shares. It's the right to sell shares at a later point in time. So at the point at which it's still an option, it is not shares short. Even though a put creates selling pressure on a stock, if the put is closed out in cash, never is it the case that the person that is short using the put, are they short the actual stock itself? Now, another way to short this stock is to short this stock and then use a call option that's deep in the money. This is called a buy right and would be captured in Regulation SHO, or at least should be captured in Regulation SHO. That's actually what the options express case was about. In other words, buy rights would not receive an exemption and would have to be accounted for as two separate legs, with the short leg being in the fail to deliver category. Now, the swaps market is its own mess because it kind of depends on how you wrote the swap. Some swaps almost look like options because you're not actually long the swap, and other swaps are structured a different way. But in both cases, it appears to me that these would not be tabulated in the failure to delivers on a daily basis. Now, there is a fine that Morgan Stanley had in 2020 for the use of swaps markets as relates to violating Reg SHO, but it's a really small fine yet again, and I'm not convinced that it means that the failed to delivers are representing the amount that's being shorted, such that it really clarifies that once you add it together, you're getting a real number on how much is naked short. If there's someone with just more knowledge on that, stick it in the comments below. I care what you think, and I will totally pin it to the top if I'm in error on this particular point. Okay, to sum it all up then, could people be following Reg SHO to the letter of the law? Yeah, they could. But is Reg SHO protecting individual investors from naked short selling? I would say it does not appear to be to me, because if you can absolutely short as much as you want and just have 3 days to cover and then just play this game over and over again, and you can compensate the holder of the shares almost nothing to do it, then you are absolutely allowing the market to manipulate the long-only investor of smaller cap names. This would be harder to do if it's a much larger cap name where the amount of capital required to do this manipulation is much higher. But in microcap land, this is not a lot of money for a fund to raise just to do this one activity. Well, that's all I have prepared for this episode. I hope that helps you guys out as a starting place for some of the other folks that have just dug massively deeper into this issue. If there are corrections that you guys want me to pin at the top, stick it in the comments below. Doing the best I can to try to help out. And hopefully, as you guys know, AMC isn't the major focus point of all the stocks that I cover. If you'd like to see more of my videos, here are some videos at AMC that you may want to take a look at. And here are some videos on stocks that have a lower dollar value where I've walked through what I'm seeing in their earnings. And hopefully I'll see you in one of those. Till next time, bye-bye.